Today I'm going to share with you 5 dumb tax mistakes that a lot of entrepreneurs are making that may cost them millions or even tens of millions of dollars over the life of their business. So my philosophy as someone who's been selling stuff door to door from age 8, someone who's been an entrepreneur in some fashion since 12, and who started his first adult business at 19 has been, it's not just how much you make, it's how much you keep. That's certainly in contrast with a lot of the direct-to-consumer businesses, a lot of the online and tech businesses that are fueled by continuing venture capital into money-losing operations. I'm not talking about that. If you're losing money, this episode isn't for you. But if you run a profitable business, I'm going to share with you 5 mistakes that I, as the Nomad Capitalist, believe you should consider changing. If it's your first time here, my name's Andrew Henderson. I'm the founder of Nomad Capitalist. It's a boutique consultancy that helps 7- and 8-figure entrepreneurs and investors legally reduce their tax rate, protect their assets, and build their options overseas through things like second passports and investments. We're also the hosts of the biggest and best offshore conference called Nomad Capitalist Live. And I am a lifelong entrepreneur who has always put profit first. Not in that profit trumps everything else, but that in profit trumps gaining users or getting more app downloads. Business should make money, in my opinion. And so this is not financial advice. I'm not giving you tax advice. Obviously, a lot of the stuff we talk about may differ from certain country to country and from situation to situation. One of the things that I see entrepreneurs doing and focusing way too much on where I'm from in the United States and in other high tax countries are tax deductions. They're buying stuff that they don't need. They're buying stuff at the end of the tax year. They're rushing stuff. They're overpaying. They're less conscious about what stuff costs. They're prepaying for services that they may not need. Maybe you sign up for some kind of software subscription online and you pay in advance for the year on December 28th, even though you may only need that service for 6 months, but you want to get as much money off your books in that tax year as possible. And I think, this almost reminds me when I see these people who they're buying overpriced assets to kind of get money away from their spouse in a divorce. So there's a case of a guy that involved Donald Trump a couple years back, a Russian billionaire who was just buying any asset he could get his hands on to get money out of Russia. And hey, he overpaid $20 million for a mansion. Who really cares? Just get it out of the ex-wife's hands. And in a sense, entrepreneurs are doing this. They say, oh, we have great financial discipline. But if you are making inorganic purchasing decisions because, oh, well, it's deductible, then you are wasting money because there's no tax deduction, or there are some, but there aren't really a lot of tax deductions in most cases where you're getting like dollar for dollar. There are certainly some tax credits, dollar for dollar, spend money on this, get that. Hey, if you want to do that, that's great. I'll talk about that in a second. But if you're buying stuff that you don't need, if you're paying extra, if you are paying for a longer service that you may not need, any of that kind of stuff, that's a very inorganic purchasing decision, which, quite frankly, I think is just wired into many Western entrepreneurs' brains, where if you were running your business in a zero tax jurisdiction, would you be making that purchase? If you move to Dubai, if you move to the Cayman Islands, if you move to any of the different tax-friendly or tax-free jurisdictions that we talk about and we help our clients with, would you be making those purchases? And I can tell you, having made that transition myself, it takes a while to kind of wean yourself off of like, holy cow, we got to rush, it's December, like what are we going to buy to kind of... I was never really too much into that because there are certain rules where you're not even supposed to do that, right? You're supposed to, kind of assign expenses to when they're incurred. Again, different tax rules, different places. But if you're chasing deductions, you're probably making some inorganic decisions, which in the long run are costing you money, and you're justifying that saying you get a deduction. You just eliminate that all if you move your business overseas and it's 0%, 1%, 5% tax. When I tell people that I live on, between my cost of living and my taxes, less than 4% of my personal income every year, people say, oh, you must be sourcing everything through the business. It doesn't really make a big difference. Even if I had a 1 or 2% tax rate on the personal side or on the business side, it wouldn't really move the needle. I wouldn't change my purchasing power in order to avoid paying a couple of percent. I may change my purchasing decisions to avoid greater paperwork on one side, but the fact is if you can get your tax rates low enough, you're going to stop making inorganic decisions. So that's the first mistake. The second mistake that kind of plays into that is hiring incentives. And certain countries, I remember when I was in the US during the global financial crisis, they were offering all these different incentives for hiring people, reduced payroll taxes. And we've taken advantage of these in certain countries where we hire, where they say, hey, if you hire people who are unemployed, or you hire people who are kind of moving back to the country from overseas, in countries where immigration is a thing. People leave and then they want them to come back and they want them to be back in the tax base. Ireland obviously has a strong immigration culture. parts of Eastern Europe, immigration culture. So in order to bring people back, hey, if you get someone to come back, we'll give you 90% discount on payroll taxes. Now, if I'm already hiring in that market, that's interesting. But I'm coming at it from the perspective of I have the choice of hundreds of different places to hire people. If you're hiring people in just one city, one state, one province, one country, then the hiring incentives start to get in the way because you're basically making decisions, again, inorganically. Hey, we can hire someone and we get a 25% credit, or they're going to reduce the payroll taxes by 50% for 2 years. You're going to then become dependent on those folks. And hey, maybe they'll help you grow your business. That's great. But are you hiring folks in the right place? If you could hire someone who is 70% less in another country, who's just as qualified, who, by the way, maybe came with fewer strategic risks, where, by the way, they also might add some technical knowledge, and you also knew you had more room to bump them up, where rather than paying them in the long run 70% less, you could pay them 40% less, which is an amazing salary for their country, but still 40% less for your country. You're going to have a lot more control over your expenses because you're not going to have someone that you're hiring at the top of the chain that you have to kind of keep moving up. So you have the cost savings there. But I don't care if you even run a physical business. Can you hire accounting overseas? If you have an in-house accounting team, if you have an in-house payroll team in some cases, if you have HR, if you have social media, marketing, anything that's not done, whether you run an online business or a remote business, or whether you run a brick and mortar business, you can probably find some people in your team that this may not lower your tax bill, right? You're just hiring somebody offshore is not going to mean you're going to pay less in income tax running your business in your country, but it could reduce your costs. And rather than chasing hiring incentives, the government doesn't really do stuff, generally speaking, that is like a great deal. The government's not in the great deals business, right? When they're giving you an incentive, hey, hire some workers in your high tax country, and again, we'll reduce the cost 50% for the first 2 years. You don't really see anything that generous that often, but even if you did, maybe you're in a certain industry, first of all, but you could probably find those incentives somewhere else. You could probably pay a lot less, and you'd know that you were getting the best people rather than just simply kind of getting sucked in. To me, it's almost like saying, I'm going to go and buy a fragrance at a store where it's more expensive, but they give me the free gift, right? You see, like the department store, they give you the free gift. The free gift is a tchotchke. The free gift is a come on. But people go in and they buy more stuff than they need. They buy overpriced stuff. They buy whatever because they want that free gift. To me, that's what it feels like, taking deductions and following hiring incentives rather than looking at the entire world and saying, hey, where could I hire the best team possible? Where are the smartest people? Where are the people that are going to help me grow the business? I'm just going to take advantage of one offer the government throws out at me. The government really isn't on your side as a business owner, especially in the West these days. The third thing that a lot of entrepreneurs do is they put money in retirement accounts. Now, again, this is not financial advice. I'm just telling you what I personally did. I never, in all my years as an entrepreneur, when I was living in the United States, said, "Oh, well, let me set up, a SEP plan. Let me set up an IRA. Let me set up any kind of." If you're not in the United States, any kind of retirement plan where I, as an entrepreneur, take money out of my company. Now, I have seen a couple of structures that people have used where we work with various tax lawyers and various CPAs, and they said, hey, this is actually a pretty good structure for this company. They may have less flexibility in how they run their company, but they're setting themselves up for a better exit or whatever. So there have been some retirement account structures that do make sense, but what the average person is doing, just taking $5,000, $10,000, whatever amount of dollars per year, tens of thousands of dollars, and just throwing it into a retirement account. Why? You've seen Western countries that have basically helped themselves to money in retirement accounts. If you are going to be paying taxes at a future date, and you're basically getting that siren song of a tax deduction now, you're going to be paying tax rates in the future when you take that money out. If you're my age and you're retiring 30 years from now, our tax rate's going to be higher or lower. It seems like a great deal based on the assumption that tax rates never go up. And yet people are socking money into things where the government can always change the rules. The government gets to control where you invest the money. They could say tomorrow, listen, you have to put your money in treasuries. Or, hey, we're going to borrow some of your money. Or, hey, you can't have too much money in here. There should be a cap. There should be a special tax. Remember when Peter Thiel had the, $5 billion Roth IRA? Yeah, politicians looked at that, and if that continues to happen, they're going to say, oh, no, you can't have more than a certain amount. They keep putting caps and limits and exemptions and exclusions. So my own personal, what I did was I did not use retirement accounts because I don't want to have money that has to basically sit underneath a separate set, an additional set of government rules for 20, 30, 40 years. And I think a lot of entrepreneurs, again, in looking for deductions are getting into that. We're thinking about. The fourth thing that a lot of entrepreneurs do is they're not thinking about their exit. Now, obviously, if you're thinking about the exit, from my perspective, your heart's not fully in the business. I'm not in the tech business. I understand some people are. They're always looking, how am I getting out of this business? But when I watch Shark Tank, for example, Mark Cuban says if you're going into the business like immediately thinking, how do I get out, you're probably not going to build the best business that you can. Reasonable minds can disagree on that part. But what I want you to think about the exit is simply in terms of when I decide to exit my country in the future, i.e. I'm going to move to a different jurisdiction, whether it's for tax purposes or just lifestyle purposes, or because you meet the love of your life and they live in Norway and you want to move there, you may have an exit just when you leave your tax jurisdiction in terms of they're going to assess the value of your company. And so if you make a move in the future, that could be held against you. But also, if you just were to sell your company, part or all of your company in the future, that capital gains tax could be the biggest tax that you ever have to face. And I think a lot of people, and I can put myself in this category many, many years ago, never thought their business would be as big as it would be. And they never thought, oh, I'd have a $50 million, $100 million company, $500 million company. And I've worked with those folks who are exiting. And I can tell you, some of them we've worked with a couple different times, and they had the chance to get out at 50 million, too painful. Then they came back at 120 million, too painful. Then we had a gentleman that's like, oh, I've got 300 and some million dollars worth of stock. I can't. How do I leave the country? And if I sell the company now, staying in the country, I'm going to have this crazy capital gains tax. They didn't think ahead. And so I think a lot of people are saying, okay, hey, I make a couple $1 million a year from a business. I'll pay $1 million in tax to live in California, or hey, just to stay in the U.S., I'll move to Texas. That makes it a little bit easier on the state tax issue. Hey, that's the price of admission. I'll pay the $1 million. And then they're looking forward in some cases to that exit, not realizing when they have the big exit and the business keeps building up, they might have a $20 or $30 million tax bill, and that is unpalatable to them because they were willing to pay the small amount of money, but they weren't looking at the big picture in the future. You could say the same thing about just continuing to grow the business, right? I mean, if you make a couple million, now you're paying $1 million in tax. Why couldn't you make a couple tens of millions in the future and be paying 10 million in tax? Never assume the business is going to stay at the same level. I think a lot of entrepreneurs obviously are very optimistic about their business, and then they kind of underestimate the optimism and how that translates into higher tax rates in the future, whether it's on exit, which is the big one, or whether it's on just general kind of higher earnings in the future. There's going to come a time when it's just going to be too much for most people, in my opinion. It's easy to say, hey, I'll pay $5,000 in tax. If you're an entrepreneur, maybe it's 50, maybe it's 100, maybe it's $500,000. There's going to come a time when you're like, $7 million a year, this is ridiculous. I'm not getting $7 million worth of stuff. So always think ahead, because when you come time to make a move, or when it comes time to sell your business, it may be too late. And the fifth thing is, going back to hiring people globally, is serving only one market. I think that a lot of folks, especially who live in more geographically isolated countries like the United States, like Australia, have this idea of just kind of serving that internal market. And when you live in the United States, again, where I'm from, you think, oh, I've got well north of 300 million people to sell to. This is a great business. I can tell you, when my parents talked about moving to New Zealand in the late 1990s, my idea as a kid who wanted to be an entrepreneur was, well, what am I going to sell to people who, in a country with 4 million people? The world has changed since then. And so when you can sell to people anywhere in the world, I don't care even if you're bricks and mortar. All kinds of bricks and mortar businesses expand all the time. But certainly if you're running an online or some kind of virtual business that can go anywhere, why would you want to limit yourself to just selling in the United States? Certainly max out that business line, max out that market, but why would you want to limit yourself in the sense of, if you could hire people in other countries and they could bring a different perspective in, or if you do what I did, which is spent well over a decade outside of the United States and traveling and going and living in different places and investing in different places, and have gained the perspective of, there are certain markets that I would want to sell to, and there are certain markets that I wouldn't want to sell to, but there's plenty of opportunity. We work with Germans. We've got great relationships with Germans. Canadians, we've got great relationships with Canadians. Okay, that's maybe, you would say, somewhat close to the United States. We've had some great relationships with Egyptians. We've had people who are in different places around the world where we've really been very successful, and they brought a different perspective than Americans, which is what I'm used to growing up. And so it balances out the business in the sense of kind of bringing different perspectives, different types of clientele in that you can serve in different ways, and that diversifies your business profile. It's a lot harder to do if you're staying in the United States. You don't have anyone working for you overseas. Everything's kind of very centric around one country, whether it's the US or something else. That to me is not only a tax mistake, but it's a growth mistake, and one that all entrepreneurs should avoid.